Want to make money in the market? Of course you do. Everyone dreams of those big wins. Imagine consistently pulling in profits from your trades. Picture yourself in control, making smart decisions, and watching your portfolio grow. That's the power of successful trading. But let's face it, the market can be a wild ride. It's full of ups and downs, twists and turns. Without a solid plan, you'll get tossed around like a rag doll. That's why most beginners never see those consistent profits. They fall into common traps, making emotional decisions and lacking a clear strategy. That's where we come in. Today we're going to unlock the secrets to consistent trading success. We'll break down the #1 trading strategy for beginners. Trend following. Get ready to ride the waves of profit. Let's be blunt. Most beginners crash and burn in the market. They lose money, get discouraged, and give up. Why? Because they make these critical mistakes. Trading on emotion. Fear and greed are your worst enemies. Fear makes you sell at the worst time, while greed pushes you to buy at the peak. Don't let your emotions control your trades. Lack of strategy. Jumping into the market without a plan is like setting sail without a map. You need a clear, repeatable strategy to guide your decisions. Ignoring risk management. Never risk more than you can afford to lose. Proper risk management is crucial to protecting your capital and staying in the game. To succeed, you need a structured approach, a reliable system that takes the guesswork out of trading. You need trend following. Trend following is like riding a wave. You identify a strong trend, hop on board, and ride it to profit. It's a simple yet powerful strategy that has made fortunes for legendary traders like Jesse Livermore and Richard Dennis. Here's the basic idea. Identify the trend. Is the market moving up, down, or sideways? Trade in the direction of the trend. Buy in an uptrend, sell in a downtrend. Let your profits run. Stay in the trade as long as the trend continues. Cut your losses short. Exit the trade if the trend reverses. Trend following works because it aligns your trades with the market's momentum. You're not trying to predict the future, you're simply following the path of least resistance. Section 4. Spotting the trend, simple moving averages as your guide. How do we identify a trend? One of the simplest and most effective tools is the simple moving average, or SMA. Think of the SMA as a line on the chart that smooths out price fluctuations. It shows you the average price over a specific period, helping you see the bigger picture. Uptrend. When the price is consistently above the SMA, it indicates an uptrend. Downtrend. When the price is consistently below the SMA, it indicates a downtrend. You can use different SMA periods to identify short-term and long-term trends. For example, a 20-day SMA will show you the short-term trend, while a 200-day SMA will reveal the long-term trend. Section 5. Timing your entry, the pullback entry strategy. We've identified the trend, but when do we enter the trade? That's where the pullback entry strategy comes in. A pullback is a temporary dip in an uptrend or a bounce in a downtrend. It's like the wave pulling back slightly before surging forward again. We use pullbacks to our advantage by entering the trade at a more favorable price. Instead of chasing the price up, we wait for it to come back down to our entry point. Look for the price to pull back to the SMA. This is a potential entry point. But remember, we only enter if the overall trend is still intact. Section 6. Protecting your profits. Mastering stop loss and take profit. Risk management is crucial for any trader. We never want to lose more than we can afford. That's where stop loss and take profit orders come in. Stop loss. A stop loss order automatically sells your position if the price drops to a certain level. It limits your potential loss on a trade. Take profit. A take profit order automatically sells your position when the price reaches your desired profit target. It locks in your profits. Always set your stop loss and take profit levels before entering a trade. This takes emotions out of the equation and ensures you have a plan. Section 7. A winning trade, putting it all together. Let's see how all of this comes together in a real-life example. Imagine we're looking at a chart of Apple stock, ticker symbol AAPL. We see that the price is consistently trading above the 20-day SMA, indicating an uptrend. The price pulls back slightly to the 20-day SMA, presenting a potential entry point. We enter a buy order at the current market price. We set our stop loss order below the recent low, just below the SMA. This limits our risk if the trade goes against us. We set our take profit order at a level where we'd be happy to take profits, perhaps near a previous resistance level. The price continues to rise, and our take profit order is triggered, locking in our profits. We successfully rode the trend to a profitable trade. Remember, this is just one example. Past performance is not indicative of future results. Practice this strategy on a demo account before risking real money. Start practicing trend following today. Open a demo account, track your trades, and see the power of this simple yet effective strategy. Join the conversation in the comments below and share your trading experiences. Don't forget to check out my other videos for more trading strategies and tips. Happy trading!